Name's Elena Campbell. I'm president of the Rochester Regional Chamber of Commerce. It's my pleasure to welcome all of you this afternoon. As you know, the Chamber is working very hard to help guide you through some new times that we are all dealing with right now, helping to guide you through in a safe and effective way. This morning, we held our second in a four-part series called Rebooting Your Business in Safe Mode. We have local attorney Brad Lambert, who is helping guide us through the executive orders that the governor is issuing with regards to reopening businesses. And that has been extremely helpful. There are two more in the series, and we anticipate that if guidelines continue to come out, we will extend that series. So don't fear. If there is more information coming, we will continue to help guide you through it. I wanted to just do a couple of announcements before I turn it over to our presenters today on some other things that we have coming up. So as you know, as most of you probably know, since this first started, I don't know, is it 9 weeks ago now? The very first week of the Stay Home, Stay Safe order, we started doing a weekly update call every Wednesday at 12:05. And this is a call where we hear from our elected officials. So we have Mayor Barnett from the City of Rochester Hills, Mayor Bixson from the City of Rochester, our DDA Director, Christy Trevero, are always on the call and give us updates from the local level. We also have usually someone from Senator Peters' office on the call, someone from Congresswoman Slotkin's office joining us, Senator McMorrow's office, and then oftentimes Representative Mike Weber's office as well. Representative Weber was able to join us himself last Wednesday as he had a break in session in Lansing. So that's a great opportunity for you to hear directly from our elected officials about what's going on at each of those levels of government. Tomorrow's call is sponsored by First State Bank. We're really excited to have Amy Person, who will be speaking on behalf of First State Bank. She'll talk about small business resources that they have to offer their clients, and she will also unveil their First State Bank's CARES website that will be geared towards assisting their clients. So we're excited about that. Thursday, really important, if you have gotten a PPP loan, you're going to want to be on this call. On Thursday, our weekly small business town hall will take place at 1:30. This is put on by the Oakland Chamber Network, which consists of all 28 chambers in Oakland County, of which yours truly drew the short straw, and I'm chair of that organization this year. So we set up this weekly small business town hall, and we're bringing on different guests each week to help our businesses. The first couple of weeks, we've had the Oakland County One-Stop Shop on the call, helping guide us through all of the grants and loans that are available for businesses. Last week, we heard from the Michigan Retailers Association. Their executive director talked about what retailers can do to get ready to reopen and provided us with a lot of creative ideas for retail spaces. And then this week, we will hear from Leon Lebrecht with Sequoia Financial Group, which is a longtime member of the Rochester Regional Chamber of Commerce, and then James LaPiccolo, who is with Capcore Professional Advisors. They both serve on the Michigan CPA Board of Directors. Leon, I know, has been extremely involved he's involved at the state and the federal level heavily, but he was extremely involved in some of the PPP language when it was first being written back when it was in Congress. So he is well versed in this program, and they are going to present tomorrow the latest and greatest information, rules and regulations from Treasury and the Small Business Administration regarding your PPP, with a big focus on what you need to do to make sure that you can get the maximum forgiveness available for those dollars. And they'll also hopefully provide us with an update on some changes, because as many of you have probably heard, there are considerable issues with regards to how the original legislation was written, and some of the initial rules that were coming out, stating that employers had to bring their they have to spend 75% of the money on payroll. However, if they weren't allowed to open yet, how could they do that? So they had 8 weeks to spend the money. So there's a lot of issues, of course, that have come up, and I know that there are some efforts to try and address those. So I'm sure he'll have an update on that as well. So I am going to stop sharing my screen and introduce our speakers for today. We're so excited to have Team CORE joining us today, and we appreciate their willingness to put together this webinar to talk about the commercial real estate industry and where we're at. And as you all know, many of us out there are tenants in commercial real estate properties, and have been, working with our landlords to try and all work our way through what's going on right now. And I know they're going to talk about that in addition to the current state of the market, and some lease negotiation insight, which will be very helpful. So it's my pleasure to introduce Sam McLean and Matthew Farrell, both of which are vice presidents in the brokerage division. They specialize in tenant and corporate representation for office, industrial, and high-tech companies. And then we also have Kevin Tamer with us as well, who is an associate vice president. So with that, I'm going to turn it over to you guys. Take it away.
Good afternoon, everybody. This is Matt Farrell. We really appreciate the opportunity to present and share some insight and thoughts regarding the commercial real estate industry here in Southeast Michigan with you today. Hopefully everybody is staying safe and healthy during these interesting times, and hopefully some of this feedback over the next 45 to 50 minutes will be valuable for you to use in your communications with your property owners, your landlords, if you are a landlord, possibly your tenants, as well as if you're an investor or a user of real estate. Some of this insight hopefully will be worthwhile for you. Team CORE, as a quick briefing, is a commercial real estate advisory company. We are a full-fledged commercial real estate brokerage firm. So we advise tenants and property owners on commercial real estate transactions for leasing and sales. We spend an enormous amount of time doing what we call corporate service work, where we are the representative of approximately 50 companies in the Southeast Michigan market on their real estate holdings, helping them make smart decisions regarding size, location, costs, and making sure that their firms are productive and profitable and growing. The second line of service that we do is a commercial real estate property management firm. So we are collecting rent and doing vendor management for a considerable amount of properties in the region, and very proud to service those two key disciplines. The differentiation factor for Team CORE is we are a team-based organization, so we rely on each other's strengths and complement each other through each other's weaknesses, and work very hard as a unit to satisfy client needs or demands. So with that, I'd like to turn it over to Kevin Tamer, who is going to transition into the market analysis and insight. Kevin.
All right, there we go. Can you hear me?
Sure can.
All right, thanks, Matt. All right, so like Matt said, we're going to focus on Oakland County, starting off on the macro level for the next 3 slides, and really focus on, like I said, a high-level overview of kind of where we're at currently, and then, before COVID, and that's going to lead us to our predictions of what's going to happen, for our tenants and landlords in the next 12 to 24 months. So we'll start off with the industrial product type. And again, really high level, the analytics that you're seeing on the screen is focused on all of Oakland County. And the biggest takeaway here is that before COVID and even right now, and what we're thinking continuing, it's a very strong performance. And we saw record vacancies and record high rates coming into this market. So just to break down for those of you who may be unfamiliar with some of the terms that we have here, starting on the left, top of the analytics, this is saying that out of all of Oakland County, there's 126 million square feet that are currently on the market. Okay, and the next slide, the next one over is that 1.1 million square feet is under construction. The next two are directly correlated, and that's absorption and vacancy rate. So anytime that we look at absorption, you're either going to have a positive or a negative absorption. And in the case of industrial right now that we're looking at for Oakland County, we have 1.2 million square feet of positive absorption. Basically, what that means when we have a positive is that demand is increasing. So more tenants are taking square feet out of the market than are being put back on. So right, that's just an increase in demand and a decrease of supply. So in turn, and what we're seeing back to my statement, we're seeing record rates. So the next couple over, we're seeing, market rates almost $8 and market sale prices for these industrial buildings hit really big highs for this product type. And in turn, another big metric that we do look at is vacancy rate. And currently for Oakland County, our vacancy rate for industrial products at 3.5%, which is very low. And in comparison, if we go to on the micro level, let's look at, Rochester is very, very in line with the rest of the market. It sits at 3.3%, $8 a square foot, and then $71 on the sale price. So very in line with the rest of the market. A larger market would be Troy. Troy sits at about a 1.6% vacancy rate with a $7.30 lease rate and a $68 sale price on the micro level. So again, really good outlook on this product type. And some of the questions is why is it so strong, currently, and why is it going to continue? And without getting too much into the predictions, some of those that we're attributing to this going to cause an effect is e-commerce and last mile logistics. So obviously before COVID, we're already, everybody's ordering online, and, the Amazon effect, you can have stuff to your door within 2 days. And that was already strong before COVID. And I think all of us sitting at home, it's probably tenfold with, us ordering stuff online of stuff we don't need. So we're thinking that's going to continue. And that was, already playing a factor in why, we have such strong performance from this product type. Again, without getting too much into the predictions, we're also seeing a shift potentially in supply lines as our manufacturers, our suppliers have a lot of the supply lines that are overseas in different countries. And obviously when COVID hit, a lot of that was cut off and you're left with what do we do? So we're predicting that we're going to see a supply line potentially coming back to the US that in turn is going to eat up some more of this vacancy rate and potentially, lead to, this product type of what we call being our front runner. So we're very optimistic on this one. And then continuing, guys, unless you have something else to comment on there for industrial, we can get into office.
Feel free, Kevin.
All right, so for office, this does apply, and Elena was commenting on that. A lot of us have office leases with landlords, and it applies a lot, but I don't want to spend too much time because we'll save a lot of that for prediction, but just want to highlight a lot of the high-level stuff here that we're looking at. And I think the consensus between our group and a lot of other different tenants and other groups in the market is that we're likely to see a facelift, and already have been seeing a facelift with office product, be it with size, or we, downsizing because of co-working, or, open office concepts. What's the flow going to look like in office space as, we navigate post-COVID with, larger space for social distancing? What's the layout's going to look like? AM shift, PM shift. We think there's going to be some type of a facelift going on here. And what the analytics, if we're looking at here, are already suggesting is that there already was one. And it's already been happening. So now we're seeing a negative net absorption. Okay, so we see that red up here of almost 500,000 square feet that's being put back on the market. So we're seeing our demand go down a little bit and more supply being put back on the market. So some of those factors that we talk about could be at play already. And, as we get into predictions, we might be seeing, what's going to happen because of that. If we're looking at, going back to the micro level, so how does Oakland County office compare to, Rochester, Troy, and Auburn Hills? So if we look at Rochester, we're at 8.3% vacancy. So a little bit under all of Oakland County. $20.60, so just over the market rents, and then $122 on the market sale price. Things like Troy, your Southfields, other, larger market, office markets like that do have higher vacancy rate. Troy's at 18.8%, so yes, well over Oakland County, with rates of $20.85 on the lease and $95 on the sale, which is pretty high, especially for the vacancy. I think that $20.85 potentially could come down. And again, a lot of these, all the product types, I think, we're expecting to see a little bit of a blip, but we're optimistic on a lot of these. So transitioning out of office leaves us with retail, and these are the three that we're going to focus on. And this is one that, a lot of listeners and individuals potential on the call could be facing with the shutdown. So I don't want to spend too much time, just want to focus on the high level analytics and pre-COVID. And what I can say is pre-COVID is retail is actually performing very well. So a lot of the analytics that we're seeing on here for vacancy rate and market was record lows, and even CoStar said, decade lows is what we were seeing. So we'll comment on things like the Amazon effect that was, displacing in e-commerce, displacing some of the retailers. But I think we also saw them, adjusting and pivoting and adapting to the consumer demand. So as those big boxes were becoming defunct, we started to see ways that they were innovating and filling them with like trampoline parks and things like that. So I think that's attributing to the kind of the record low vacancies that we saw here. But obviously, as we start to get into the, now past COVID, we're getting pretty hit on the hospitality industry with the shutdown. So we'll get into that onto our predictions. And again, with these, the impact on the shutdowns right now, we do feel that there's going to be some opportunity for tenants and landlords alike. So that brings us to kind of our next slides of, what do the next 12 to 24 months look like? What are the opportunities for tenants, landlords alike? And then how are these analytics going to apply to all different, to the different product types?
Kevin, we have a couple of questions. Do you want me to wait or?
No, I think we should. I think we've got a smaller group. Matt, if you want to open it up and just do a town hall, by all means.
Yeah, feel free.
The question is, has the vacancy rate always been near 10% for the last few years? Do we know?
So I'll give you a little summary history on the office sector. So I'll hone in on that right now instead of the industrial and retail. The office sector in 1999 reached a sub 3% vacancy factor. In the 2008 market crash in October of 2008 started the significant exodus of over 1 million jobs in the Southeast Michigan marketplace, and we peaked out at almost 32%. Since the 9 to early 10 recovery time period, it has continuously absorbed square footage and space and recovered. But I would say that the office market was still in a recovery and recovery growth market going into pre-COVID. The industrial market, on the other hand, was very, very strong statistics, strong rates, very historically low vacancies. And the retail sector was already dealing with the Amazon effect and the big box retail adjustments or mall adjustments in the retail sector. So to answer the question on, has it been 10% historically? No, it has varied in the 3 to 30% vacancy range, but all were in a recovery and dropping vacancies going into pre-COVID. And we anticipate that we're going to see some level of increase in all three class types. However, the industrial market should recover the quickest.
Okay, and I think you answered part of the second question. What was Rochester's vacancy during the 2008 financial crisis?
So we're going to pull that up to give you an exact number to help answer. Let me ask, does the participant want to hear on office, retail, or industrial? We'll make it specific. Amy, are you on? You can unmute office. Office. We will research that and we'll give you an answer during this session. So you have an accurate number of what it was in the October of 8. And I'm going to suggest we also look at the October of 09, because the cause and effect of the 08 crash really wasn't felt statistically until about a year later. So with that, any other questions? So let's jump into the predictions. You know, we don't obviously have a magic crystal ball. If we do, it's fairly blurry at this point, because we've been touching it and tossing it around the office so many times to see if anybody can figure out what the prediction is on the future. However, what we do believe is there's some sound fundamentals that were in place and will still be in place post-COVID. So let's speak industrial. We know here in Southeast Michigan that we are still home to the automotive sector, and the automotive sector drives an enormous amount of jobs and job creation in this market, and that a number of jobs are affiliated or tied to the auto sector in 1 degree, 2 degree, or 3 degree separations. And in light of that, the auto sector was doing relatively well going in. They obviously shut down quickly. Some of the lots and the dealerships have really increased inventory. Vehicles are not selling right now. That is a challenge that's going to be a lingering challenge post-COVID. But the industrial market, we feel, in light of these new realities of waiting for medical devices, waiting for pharmaceuticals, waiting for PPE materials. We've been hearing a lot about this at all segments of media. We feel that the US market and US economy is going to work really hard to avoid waiting on staple products, staple goods, toilet paper, or things of that nature from third world markets or from other foreign areas where there's shipping tariffs and or politics involved. We think that the US market is going to be very strong-minded on getting back to work in the let's manufacture it here and let's take advantage of building it, selling it, and utilizing it within our marketplace. So we think the industrial market is likely going to see some level of surge because of that. On the opposite side, though, it is going to see a little bit of pullback with the auto sector. You know, as there's a new watermark of amount of vehicles that will sell in the next 12 to 24 months, how many new automotive lines will come online, how this disrupts, as Kevin mentioned earlier, the supplier base and some of the supply curve for parts and materials. That is going to be a very real factor, and we're not quite sure how that's going to shake out, other than I think we all know or have a keen sense that we will all be in a safer and a more knowledgeable position 6 to 12 months from now than we are today. So one of the strongest pieces of advice that we're giving a lot of our clients in all segments, office, industrial, and retail, is it's not necessarily prudent to make knee-jerk reactions. It is prudent to do a lot of fact-finding, a lot of research, pull together the data and the analytics to make informed decisions. And I'm sure all of us on this webinar and call have spent a lot of time in the last month and a half learning about the PPP program, learning about stimulus opportunities and the EDIL, what the ability is for that to maintain your staff and employees. Do you have to go to unemployment means? You know, we're all in this together. And probably the most overarching advice that we've given a lot of our both tenant clients and landlord clients is, as you analyze your business pre-COVID and you're making decisions today regarding PPP or other stimulus or unemployment, because you have to, the simple way of looking is, if you feel your business model is a revenue producing business model post-COVID, and that you have a level of revenue generation and a marketability that has a higher probability of success, then the PPP is likely a path worth taking, and one that you should have already taken at this point, whether the first round or in the second round. If your business model, in your perception, is forever disrupted because of the COVID changes or social distancing or the cause and effect of the forced sabbatical that we've all taken here for the last 8 to 9 weeks, then you may be looking at the unemployment solutions or other more drastic measures to try and address those issues. But probably the most important thing to take away is that we are all in it together. And we tend to believe that you win more with honey than you do vinegar. And the key there is to have good, open, honest communication with your vendors and with your customers on both sides of the aisle, and be able to open up that dialogue and support each other in what might be needed time of change or needed time of support. So as we look at the office market, we feel the office market is way too premature to predict where we're going to be in 12 to 24 months from now. We believe that patience is going to be a virtue with the office market in learning more about the human conditioning of going back to the office and back to work. We know people that don't want to go back to work. We know people that can't wait to go back to the work because they've had a little too much time with their spouses or other things. But we also know that there's a lot of businesses that don't function that well without being in the work environment for culture and camaraderie. But there's also a lot of businesses that were forced to learn very, very quickly that this is a pretty high efficiency way of getting things done when you don't have to sit in traffic and commute to and from offices or meeting places. So there's a lot of perceptions out there and almost too much to absorb. And as Kevin mentioned earlier, we are going to see a fair amount of interpretation of what is safe social distancing, what is safe head count within office space. Pre-COVID, the US office market was working towards a 155 to 170, that's 155 square feet to 170 square feet per employee average. 7 years ago, it was about 255. Your average law firm's at about 400. Your average call center is about 80 to 90, just to give you a comparison. But the US average was working its way downward because of tools, technology, paperless society, 2 screens on a work surface versus 1 computer and stacks of paper, just to give you for instance. And we're already hearing and seeing that companies are going to dial back the other way. They may go back to that 200 to 225, maybe even 250 square feet, but they're also going to reduce overall footprint, square footage, because they're going to require less bodies in the office. And so there's going to be a push-pull of those 2 effects that will ultimately find a new watermark or a new customary standard, if you will. But we do believe it's too premature and too early to tell on the office sector. The industrial sector, as we mentioned, we feel very confident. It was stable going in. It was, in many cases, preserved, in some cases damaged. But we do believe that the industrial market has a high probability of rebound and rebound relatively strong and being one of the strongest classes coming out. The retail sector is one that affects a lot of people. Restaurants, retail, shopping, your staple goods, your grocery stores, you name it. It's a fairly large, vast category. There was record numbers of restaurants going into COVID, record numbers of fast casual dining, record numbers of solutions to not eat at your own dinner table 5 days a week. Obviously, many of us were forced to eat at the home dinner table for the last 8 to 9 weeks and go back to those roots. It will create a fair amount of pent-up demand to go back out. But at the same token, if a restaurant, and speaking specifically to a restaurateur, if the restaurant is under a lease obligation with a landlord and that lease was benchmarked on a certain amount of chits or sales per night and turns of the table and how much population or density coming through, that's going to be challenged in the immediate future. And not only by government and state requirement, but public opinion and public feeling and perception requirement thereafter. So financially, a lot of the restaurants who are under lease obligations are in a challenged position and almost need to address their landlords or need to find a better resolve or solution to what the business looks like post-COVID. Those restaurateurs that own their properties or that have a niche deliverable and satisfy on a smaller seat count or a slower turn of table will probably weather the storm better than the contrary, just because they can control that destiny a little bit better. As it relates to financing and debt, the market was as aggressive in financing as we'd seen it since the 06, 07, early 08 era, coming into the end of 2019 and the first quarter of 2020. We do believe interest rates will stay artificially low for the foreseeable future. We do believe that the ability to get debt is going to be hampered by the challenges at the banks and their perception of value or their perception of a viable need. But a strong balance sheet or a strong borrower should have no trouble with their banking relationships and their lending relationships to obtain financing and debt, especially when it comes to brick and mortar real estate, because many believe it's a better safe harbor for those dollars than elsewhere. And Sam, why don't I turn it over to you on the returning to the workplace and a few comments there. Continue on.
Yeah, so I guess that really jumps into the executive order that was placed yesterday, and that kind of sets the forefront for what's going to happen with returning to the workplace and how that's going to happen. So there's, guidelines that have been put in place, and I know Zach Warson, our head of property management, has been working on that as well with the buildings that we property manage, setting up, what happens if you do have an outbreak and stuff like that. So I think all of those details are being ironed out, and it's a lot of uncertainty at this point. But as it comes and as it goes, I think people are going to start to learn to what the norm's going to look like. How long is that going to last? Is it going to, last the rest of the year? Is it going to continue into 2021 for, the temperature checks and stuff like that? But I think, there's a lot of uncertainty there as well. But figuring out that as we go and, being more safe than sorry is kind of going to be the route, in my opinion.
I think we all agree upon that. And the at-home versus at-work capabilities, many companies were capable of this prior. Almost all have been forced to become capable of doing it during this process. And it will be very interesting over the next 12 to 24 months to determine how the general business climate will shift and adjust to more open culture, open or unlimited PTO, paid time off campaigns instead of your attendance records, if you will, at office spaces, and opening up the work from home capabilities and metrics. Really what it comes down to there is culture and accountability. If employers feel that their staff are accountable and are productive and getting the job done, then they're more apt to permit it, allow it, and endorse it. If they don't feel that way, or they don't have the business that allows that, then it's going to likely err towards more time of at office capabilities. But we are seeing a lot of questions, a lot of feedback from large companies, large clients, large tenants, all the way down to small 2, 3, 5 person offices, all asking the same question. Can we continue a significant portion of our business environment from a work home scenario for the foreseeable future? Or is this temporary and only going to happen for the next 3 to 4 months? Which is why we really err back to not making the knee-jerk reaction, follow your safety and gut instincts first and foremost, and navigate that as we see a better clarity over the next 6 to 12. On the next bullet point, owning versus renting, we'll only spend a quick minute here. One strong point that our team always advises our customer base is if you can own, a lot of people like to own, and the accountants and other advisors around business owners or businesses will advise if you can own. If you need to rent, rent. However, we think it's a little bit different than that. And that is, if you are unsure of your size, whether you need to grow or contract, renting is where you want to be. Because renting gives you the ultimate flexibility of growth or contraction or relocation. Once you own, you're likely in it with a fair amount of equity and or a fair amount of debt. And you need to know that you have an exit strategy on how to get out of that if you need to make change. So that's the first comment. But probably the most important comment is, we always like to advise clients, do not make the own versus rent decision premature. If you go to the marketplace with a fixed interest of only renting or only buying, only owning, you will likely miss the right opportunity that makes the most sense for the business. Instead of making that decision early, make that decision on a property by property basis late in your campaign of how you're making those decisions, i.e., find the right property that gives you location, gives you safety, gives you the amenities you're looking for, gives you your signage, your marketing, your exposure, your travel patterns for your customers, your travel patterns for your employees and your critical staff, and make the decision based on that first. And then while you're analyzing one or two or up to five or more properties, then do a side-by-side analysis of, does this property make more sense to purchase or does it make more sense to rent? And obviously there's a lot more decisions that go into that, i.e. equity, capital, and timelines, because the purchasing process is often a longer timeline than finding space for rent. However, it's important to make that decision in our belief later in the process, not on the front end of the process. We do believe there will be a fair amount of new inventory coming back online over the next 6 to 12 months. And therefore, the opportunity to purchase properties may become more advantageous in the next year. And maybe that perfect property that you didn't see yesterday will be servicing here in 6 to 12 months. Kevin, next slide, please. So this next piece is really an important, current, right now, critical piece of information that we're spending an enormous amount of time with our customers, both on the corporate service, the tenant side of the equation, as well as on the property owner and landlord side of the equation. Retail landlords have been getting this question of how to deal with rent deferrals, rent abatements, or lease adjustments accordingly, because they don't have a customer walking in the front door, and they need to be viable and have the capital to cover their rent obligations to the landlords. The first point is communication is key. There's very little harm in conversation, and there's a lot more good that comes out of it by being open, transparent, and honest about the circumstances. You're better to ask and have a dialogue around these circumstances than you are making a unilateral decision and then putting yourself into a difficult position that will take a long time to resolve. The legal process has its place and is there for a reason to manage these things when needed, when conversation or mutual resolve fails. But the legal process in the county and the state, in light of COVID, is significantly backed up, and we're not going to see a lot of business negotiation or business law dynamics come through that pipeline for quite some time. So if tenants choose to just not pay rent and not speak with their property owners to work out a resolve, it could become a very expensive, very problematic resolve for both parties. However, if you approach that landlord and have a discussion regarding the circumstances in the business, if you're in retail, there's an obvious challenge. If you're in the office sector, it may not be as obvious. You may still be able to function a good percentage of your business off-site and from home, and you may have been able to take advantage of the PPP opportunities in the stimulus package. By using those tools and communicating, a landlord that is capable or able to work with you will likely want to do that because they want to protect your tenancy for the future. However, there are limitations to what they can do, and not every property is the same. So it's very important that it's reviewed on a specific location, type of use, credit of the lease, the language of your lease document, and the options and rights that both you and the landlord have in order to work through those dynamics. But it is not uncommon for things like the following to be facilitated during this time. We have seen retail tenants have rent abated for a series of months, 1, 3, upwards of 6 months. We have seen them deferred rent, where landlords work with their lenders to get approval and then amortize that deferral with interest over a next 12 to 18 or 24 months thereafter. We've even seen landlords work with tenants to say, I will grant 3 to 4 months of deferred rent. However, I'm not going to charge interest. I'm not going to ask for more term or more contract. I'm just going to amortize it over the balance of the lease payment or balance of the lease term. And the benefit in doing that is actually a two-way win-win in certain instances, not in all, but in certain instances where the landlord gets a little bit of a bump up in rent on their contract because of that new amortized amount being added to the original contract. And the tenant gets the 1, 2, 3, or 5 month deferral today in a time of need because of cash flow issues. That is a fairly healthy and very fair win-win in certain circumstances, but doesn't work for all properties and doesn't work for all situations. And there's a few reasons why. In the lending market, the vast majority of the real estate in Southeast Michigan is financed. And those financing metrics come from typically one of 3 forms. It's either smaller debt in the SBA form, which is the Small Business Administration, i.e. a user, an occupant, or an SBA loan. And in that case, you're relatively in good shape because the SBA, without your request, has already given you a 6-month deferral on principal and interest and has pushed it out for 6 months and likely already notified the SBA borrower of that. If the landlord or the lender or the borrower is working with a regional bank, a local regional bank, Flagstar, PNC, Level 1, your regional, upwards of national, but bank institution type work. The banks are so extremely busy with the PPP processing that they haven't had a whole lot of time to digest or staff up or ramp up for working through their loans and their assets. But they are willing to have those discussions, but they're typically going to be dealt with on a one-on-one basis in a hardship manner. And it's going to be reactionary, not proactive. We have yet to see a bank come out proactively to do something across the board, but we have seen them react reactively to a hardship issue. And in that case, they're potentially willing to defer the principal payment, the interest payment, possibly the principal and the interest payment for a period of months with some level of a repayment plan or a balloon at the end of the maturity of that loan. And many landlords we've talked to, if they're able to obtain that, they've been willing to pass through that benefit to their tenants in the recognition that we're all in this together. And if the landlord can save on those payments, then they're willing to pass through that proportionate savings to the tenant occupant so that everybody can survive the circumstances. Now, the third tranche of finance that is a little more complicated is your CMBS and your life company market, which is your larger portfolio properties, your larger multi-tenant office buildings, your large industrial properties. Many of those are in a conduit and securitized mortgage, securitized loan. Wall Street and the securitized market has not been able to determine any meaningful pragmatic plans to address that on the larger scale. And the CARES Act doesn't and has not addressed it yet either. So the landlords of the larger properties are likely in a position with their hands tied, not able to offer a whole lot to a tenant in benefit because they're still looking at a fixed payment on a mortgage. with fairly few exceptions. The exceptions would be in the category of the big box retail space. We have seen the conduit market and the life market step in to try and help on the big retail, knowing that the amount of exposure there is fairly significant. So with that, Kevin, Sam, is there anything else from a presentation standpoint, or should we open more up to questions and answers?
I can start with answering the question that was previously asked, Matt. So looking at Rochester and office space in Rochester, in 2008, the vacancy rate was 13.6%. And then after that, in 09 and in 2010, it jumped all the way to 18.6. So the vacancy rate wasn't necessarily at the record high. In 2008, it took a little bit of time. It took a couple of years for it to jump all the way up to 18.6. And since then, it has steadily dropped all the way down to the 8.4 that we're at right now. And at the peak of, or the smallest vacancy rate, I guess you could call it, was at 4.1 in 2018. So it has jumped up a little bit since then as well.
We follow 3 key metrics on a pretty regular basis to help gauge the health of the climate and health of the real estate market or health of the business market in Southeast Michigan. Number 1 is unemployment. Number 2 is population growth. And number 3 is the auto sector and the auto sales. So if you have a takeaway of keeping an eye on those 3 metrics, they tend to be fairly good predictors on what's going on and what's coming. And I'll go a little deeper on that. The Michigan unemployment rate in October of 2020 was at a significant low of 3.6%. Obviously, we've all seen a huge spike in the unemployment factor in light of COVID and the CARES Act and the increased benefits to the unemployment sector right now, and the increased pay in the unemployment sector to help survive the circumstances. But it'll be real interesting post-COVID how quickly the employment market can absorb that and get back to what we'd hope to see would be a sub 5 or sub 6 type number. But at the same token, going in, we were at a very low number, which left the labor market with very little depth, meaning there were a lot of jobs that were out there and being unfilled, or companies that had desires and demands and needs that they weren't able to find good candidates for prior COVID. The next one was population growth. And Michigan is not growing at a pace that a lot of other markets are. However, we have one of the largest substantiated industries in the auto sector that produces significant high-paying jobs, engineering jobs, finance, executive, so on and so forth. And it's a big draw for employment, coupled with our medical community and our universities. So those 3 segments are huge opportunity drivers for the Michigan marketplace. However, we have been playing a lot of what we call, Peter to pay Paul kind of scenario, musical chairs in the real estate sector for a long time, for almost a decade. And with limited population growth, just in theory, when one person buys a new home because they want something new and they sell their home to the next person, that person moves from somewhere else and likely something's left vacant. Same thing happens in office, happens in retail, happens in apartments. So without population growth or meaningful growth, we are essentially playing a little bit of musical chairs in all class types. The third is the auto sector and the auto sales, and just keeping an eye on it on a monthly basis and where the numbers are reported, Ford, GM, Chrysler, and the non-domestics, so that we can have an idea and have a pulse on the consumer spend and the consumer movement. And we can open it up to more questions, please.
We have a question in the chat box. I am helping a client find a new space for a medical office in or near Bloomfield, Birmingham. What duration of lease should she insist upon with the state of the current market? She will have multiple practitioners in with her as well and will need ability to scale up.
So, Kevin, Sam, I'll attack the beginning of this, but feel free to chime in. Medical is driven largely by the tenant improvements required for them to open up the operation, and who is going to write the check for the improvements to the space. In all instances of real estate, industrial, office, and medical, to the extent you can find something that's works substantially as is, you have a greater amount of leverage to negotiate better terms, better conditions, or a shorter lease term. To the extent there's a lot of improvements needed, especially in today's market where construction pricing is at one of the all-time highs, the term comes into that discussion usually as a means to amortize those improvements and to get enough commitment from a medical tenant so that that investment can be made. The question is the investment made by the tenant or is the investment made by the landlord? And in many cases, it's both. Sometimes it's only the tenant. In many cases, the landlord puts a significant amount of improvements into that solution as well. But when you're looking at large numbers in the medical office market or high-end office build-outs, normally both parties are participating. The landlord's providing certain amount of allowance or a certain defined scope, and then the tenant is taking on the additional things above and beyond that scope, including their fixtures, furniture, cabling, wiring, low voltage cabling, security. Those things typically fall to the tenant side of that ledger. But from a term standpoint, medical, once situated, doesn't like to relocate. It's very, very much like a retail. Once you've become in place, your customers or your patients, they're coming to you because they know you're there. Same with retail and Starbucks. Starbucks is there. They don't want to move. They have long-term leases. They lock up long-term renewal rights because once they prove a location, they don't want to relocate from that location if they don't have to. Medical is very similar. And we typically see medical tenants signing at minimum 5, but typically more like 7 and 10-year leases in order to secure the space and obtaining 1 to 2 renewal rights for upwards of 5 to 7 years each.
Okay, thank you.
You're welcome.
We don't have any other questions in the chat box. Does anybody have anything else they'd like to ask? No? Okay, well, we'll go ahead and wrap up. Thank you so much, Matthew, Sam, and Kevin. This was fascinating, actually. I love data and numbers, and it was really interesting. I'm glad you gave us some of the comparisons with 08, 09, and shared with us some of your thoughts about the future and, you know, what's going to happen possibly over the next 6, 12, or 18 months. That's really helpful. So
our pleasure. Thank you so much for having us. We really appreciate it. And we're always here to help and assist if anybody has any questions. Circumstances are reviewed on a case-by-case basis. They're often complex and they need to be navigated in a healthy way to get to healthy results.
That's right. It's not so simple as signing a lease or taking out a mortgage, right?
Exactly.
All right. Well, thank you, everybody. I just want to remind you again, you know, tomorrow we have our update call at 12:05 where we hear from our elected officials. And then Thursday, if you have that PPP loan at 1:30 p.m., we've got our small business town hall where we will hear about the latest and greatest rules and regs for that. So thanks again, everybody, and we will talk soon.
Thank you so much, everybody. Stay safe and stay healthy. Thank you.
Farrell.